Welcome to The Explainer. Today, we're diving into a really powerful, data-driven way to think about investing in the Indian stock market. It's all about moving beyond just gut feelings and getting into a systematic approach called multi-factor investing. Okay, let's get right into it.
So, let me just start by asking you a question. What if you could build your entire portfolio based not on guesswork, but on the specific, measurable traits, or what we call factors, that have been proven time and again to drive stock returns? That's the big idea we're going to unpack today.
All right, first things first. To really get this, we need to understand where this whole idea comes from. We're talking about a major shift, moving away from a really old, simple way of looking at the market to something much, much smarter.
You see, for decades, the big idea in finance, something called the capital asset pricing model, or CAPM, was pretty simple. It basically said a stock's return comes down to just one thing: how much it moves with the overall market. It's beta. But as it turns out, that is not even close to the whole story. And this timeline right here shows you just how much that story has evolved. After 1964, that single-factor model was king, but the real game changer came in 1992, when researchers Fama and French discovered two more factors: a company's size and its value, that could explain returns way better. The model kept getting better, adding things like profitability in 2014. And that brings us to today, where we use even more factors like quality and momentum, which we're about to dig into right now.
So what are these factors anyway? The best way to think about them is like the high-performance parts of an investment engine. Let's pop the hood and look at the three big ones that are critical in today's models. First up is value. This is the classic strategy, right? It's basically bargain hunting. You're looking for great companies that, for whatever reason, the market is currently selling at a discount to their true worth. So why does hunting for bargains actually work over the long run? Well, the theory is that investors get paid a little extra, a value premium, for being willing to take on the perceived risk of buying these companies that might be going through a rough patch. It's a classic risk-reward scenario. Next, we have quality. This factor is all about finding the opposite of distressed companies. We're looking for the A-plus students, businesses that are incredibly healthy, with huge profits, stable growth, and very little debt. These are your rock-solid, blue-chip champions. And why is this so critical? Well, high-quality companies are built to last. They tend to be way more resilient, almost like a defensive shield for your portfolio, especially when the overall market hits a rough patch and starts going down.
And finally, there's momentum. This one is based on a really simple, almost behavioral observation. Stocks that have been winning tend to keep on winning. And stocks that have been losing, well, they tend to keep on losing, at least for a while. It's all about riding the trend.
Now, what's so interesting here is the challenge. Momentum can be an incredibly powerful force, but it's not as simple as just buying whatever went up last month. You have to build your model carefully to filter out all the random market noise and make sure you don't get trapped when a trend suddenly reverses. Okay, here's a really crucial point. You can't just take these big global academic models and just drop them into the Indian market and expect them to work. The Indian market has its own unique quirks, so you need a recipe that's adapted specifically for it. And this slide is the perfect example of what that adaptation looks like in practice. On the left, you've got the standard way of measuring a stock's value. But for India, as you see on the right, a much smarter model makes some key adjustments, like tweaking for local accounting rules to get a way more accurate picture of a company's real value. And the list of necessary tweaks goes on and on. A truly robust model for India has to handle all sorts of local issues. You need filters to make sure you can actually buy and sell the stocks. You have to account for something called survivorship bias by including companies that went out of business, so your results aren't artificially rosy. It's all about that rigorous data work because, garbage in, garbage out. So, with our specially adapted factors ready to go, how do we put it all together? Well, it's a very systematic process. You can almost think of it like an assembly line for building a portfolio. This diagram shows you that 5-step assembly line. You start with this huge universe of stocks and filter it down. Step 2 is that all-important data cleaning. Then in step 3, every stock gets a score for each factor. We use Z-scores, which is really just a statistical way to see how a stock stacks up against the average. At step 4, you combine those scores into one master rank. And finally, step 5, you just select the top-ranked stocks. It's a disciplined, rules-based process every single time. Okay, theory is great, process is important, but does this thing actually work? This is the moment of truth. Let's put this model on the dyno.
run the tests, and look at the actual performance results in the Indian market.
And the results are pretty darn compelling. This table shows the model head-to-head against the Nifty 500. Just look at that 2018 to 2020 period. The model returned over 21% when the market was below 9%. But the real key is that bottom line. Over the entire 10-year period, the model delivered an annual return of almost 19%, crushing the market's return.
This chart just makes that difference crystal clear. The gap between those two bars, that's the whole story right there. It's the value that a systematic, data-driven strategy can potentially add over just buying the market index.
And this is the bottom line, the one number to remember. An average outperformance of 6.6% every single year. When you compound that over a decade, it shows you the incredible power of this kind of systematic approach.
So you might be asking, where did all that extra return come from? This chart breaks it all down. Value was the heavyweight champion, driving almost half of the outperformance. But quality and momentum were huge contributors too. And what's really key is that by combining them all, you get this much smoother, more consistent result. It's the power of diversification in action. And this brings us to one final huge question to think about. The factors that have worked so well in the past, value, quality, momentum, are pretty well established. But as our world evolves, with AI and all these new sources of data becoming available, what will be the winning investment factor of tomorrow? And that right there is what makes this field so incredibly fascinating.